Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. On this weekend show, we're going to be talking a lot big picture markets with this really risk-on, powerful move that we have seen in a wide range of sectors across the U.S., within U.S. markets, cryptocurrencies as well, after that election results with the Republicans really sweeping that election. We are, of course, going to focus on the precious metals as well and talk about, I guess, some of the lack of interest, the loss of interest that we have seen where these precious metals markets could correct to. Everyone, please go back through our website, kereport.com, and search for our podcast in your podcast player. Just search The KE Report to listen to all our daily editorials and company updates that we record throughout the week. On this weekend show, we're starting off with one of our favorite longtime guests, that is Richard Postma, aka Doc. Second half of the show, we're going to be then shifting our focus more big picture market, seeing all the opportunities that are presenting themselves to all the investors with Mike Larson. As I said, we're kicking off with Richard Postma. So Doc, really appreciate you joining us for really what has become more or less monthly calls here. However, we did skip October. Now that we're in November, what a wild ride precious metals have been on. Gold has been almost going straight up since March, but I've noticed a pretty defined turn in the gold price and even more so in the underlying stocks at the tail end of October. Doc, just a broad question. In your eyes, what does the overall health of the precious metals sector, especially gold and silver, look like to you right now?
Currently, Corey, I might mention that last time I was on, I mentioned we'd probably see some tax loss selling. But I think what we're starting to see is something more here, beyond tax loss selling. I think we're going into a kind of a moratorium period for gold and silver, where we're going to be trading down to sideways for a number of weeks here, moving into 2025. I know that's kind of discouraging for people, but what's really discouraging is to see the price of gold, and yet so many of these precious metal stocks not doing well. And so I think we're starting to peak here a little bit, and we may just take a rest for a while, and it may be a little bit longer than people like, but that's another chance for people on these pullbacks to buy back into these positions.
Well, Doc, just to that point about the underperformance of the mining stocks versus the metals, we've talked about this all year long, it seems like. When we saw gold make a move from 2,000 up to 2,800, you see silver wake up from the mid-20s or low 20s all the way up to 35. Most people would have expected a bigger outperformance in the mining stocks. And we can point to some individual companies that have done well, but as a sector, the sector has not done well. And definitely when you drill down into the juniors, they've really disappointed investors. Is there something that's disconnected this time that we haven't seen in other cycles? Because in other cycles, even 2020 or 2016 or even 2018 to 2019 that are fairly recent, and if you go back to the 2001 to 2011 time period, that run, we at least saw the stocks outperforming 2-3x to the metals price. Other commodities have moved up, like oil and gas, and their stocks have moved up. Even when copper went to $5, the copper stock shot up. Why are the gold and silver stocks not responding to the higher metals prices?
Yeah, that's amazing to me. Maybe, and we talked about this off mic, and maybe it's an old investment theme that nobody has interest in anymore. Maybe the young people and others that are investors look at other things more exciting, like cryptocurrencies or AI or other of these platforms that are really getting speculative attention right now. And it could be that it's just a sector that, based on some of us that have been around for years and interested in it, the younger generation and the younger population that have some dollars to spend and invest, just have no interest in, and that wouldn't surprise me at all.
Well, Doc, you can't spell gold without old, right? The problem being here, and you brought up the cryptocurrencies, is that, look, with Trump in office, it almost seems like the dream scenario for what gold bugs were hoping for in terms of a leader of the U.S. talking about an asset. He's talking about Bitcoin and cryptocurrencies as somehow including it in their economic backing, being much more friendly to something like cryptocurrencies. And even other large companies are saying, well, maybe we're going to hold cryptocurrencies on our balance sheet other than just US dollars. They're not saying that about gold. So is this the big problem right now? Is that the time for gold seems to be behind us, and there are other assets that, whether gold bugs like it or not, have taken over that narrative, whether it's right or wrong?
Yeah, I think that's a very good possibility. And like you said, the Financial Times and other of these periodicals, what do they talk about? They certainly aren't talking about gold and silver, and they are talking about cryptocurrencies. And of course, Trump going to those conventions and being positive toward those people. And it's a younger set again in this country. And so that's what they're focused on. It's on things like the cryptocurrencies and AI and any other new pablum or idea that comes, front and center. And I think that's a real big problem right now. And gold is just not in their attention area right now. And that could change again, after we run out of other speculative investment modalities. But that's a real problem for gold right now, and also for silver.
Well, Doc, another thing that I hear when we talk in different networking circles, when we go to conventions, when we talk with other companies and other key strategic investors, is the gold sector, and to the same degree the silver sector, has disappointed investors really for a long time now, over a decade, as far as their inability to get their house in order. And I would argue that a lot of the bigger companies and mid caps did work on it. They, shrunk their debt, they improved their balance sheet, but they continue to disappoint. This recent sell-off it was kind of triggered by the sell-off in Newmont when they missed their expectations again. There's no doubt that these companies are making a lot of money, but when you continually miss market expectations and analyst expectations over and over again, a lot of people just throw their hands up and say, I'm going to go somewhere where the valuations don't matter. It's just really, speculative fervor, as opposed to a sector that's perpetually disappointed. Do you think it's that the mining sector is its own worst enemy in perpetually disappointing investors' expectations?
It is, and that's why it almost seems that, we always talk about the juniors and, boy, the 10 baggers and, putting your money there. And of course, you have certain people in that industry that have talked that stuff up for years. But it almost gets to the point where you say to yourself, there are maybe only 2 or 3 companies I want to look at anymore that actually are well run and that have nice profit margins, and their price earning ratios aren't in the stratosphere. And that seems to be what's happening now, is that people are becoming much more selective, and they're treating these things like you would some normal stocks as far as PEs and their cash flows.
Yeah, one thing I was talking about off mic with you, Doc, too, is that, look, some of these growth sectors, as much as their PE ratios get completely out of whack, like chips or a lot of even tech, right, is that when the market takes off, when there's demand for their product, these companies can scale. They can grow their production or whatever product they're providing. Gold companies they have trouble doing that. You can't just flick a switch and bring a mine online. So they can't take advantage of these higher prices by increasing production. They simply take advantage of them by doing what they're doing and just selling at a higher price. So that, in a way, kind of limits the growth that they can take advantage of when we're at these higher prices. But it is kind of crazy to talk about how just tough this market is and how these companies are struggling when gold has gone up arguably 3x in 9 years. It's up about 50% just this year alone. So let's move over to the chart a little bit more then, Doc. The gold, I know you like to look at the monthly charts, but if we started something like a daily chart here, it was higher highs and higher lows pretty much the whole way from March when it started breaking out, and it's been arguably in an uptrend since, I believe, 2018 when a much bigger bottom happened there. But Doc, what are you seeing in that gold chart? How much deeper could this correction go, or is this bull run over?
Well, I think the odds are very good. We're going to see 2,400 to 2,450. That, I think, is baked into the cake. Then it becomes, once you get down to that level, it'll become clear whether we're even going to break lower than that. But so we're going to have to wait a little bit here over the end of the year and into early next year to see if the chart then sends out a warning that maybe we're at the end of this particular bull run, and then that we're going to move sideways for a year, 2 or 3. It really disturbed me, and I mentioned it a while back when the 12-month was really segregated from the 26-month moving average. That's always a warning, because when it turns, it often turns rather viciously. And I hope that we're just going to move down to 2,400 and then move into a trading range for a while. And that's a possibility. But at this point, it's hard to tell whether that's going to happen. We'll know more in a couple months, I think, on whether that's a good possibility. That then we'll just trade sideways, probably a good part of 2025.
Well, Doc, in that kind of environment, if we're in a sideways channeling market, generally that does not bring in the momentum traders and that does not get the animal spirits going. But in this case, $2,400 gold, while it'd be lower than what we've seen, would still be a pretty good price for most producers that have costs far below that. They'll still be making money. Is it possible that quality stocks that are run better or that have some catalyst can still keep catching up to the move that gold has made, even if gold were to pull back or channel sideways?
Yeah, I think that's very possible. The ones with good profit margins and cash flows and showing that they're going to produce more ounces, and especially if energy prices stay low, I think they can do pretty well. Of course, doing pretty well can mean that they don't get really clobbered as far as their prices, as far as their price earnings, like some of these companies. But so many of them have sold off so much that there's not much further to fall, and they'll fall back into their trading ranges, waiting for the next possible surge in gold. But yeah, the better run companies, I don't think will suffer much in this pullback.
Doc, what about this whole concept of a catch-up trade? We've asked a number of different commentators about it. The fact that, look, we've been talking for years about how the gold stocks have lagged the gold price. Even when the gold price was much lower, people were saying the gold stocks needed to be higher. What's your take on this whole concept that because the stocks have lagged, there needs to be some sort of a catch-up trade?
Yeah, there sure needs to be catch-up, but I think with what we've seen historically so forth, it's not going to happen. Even if gold trades sideways, you may get a little bit of a run periodically, but you're not going to get another sustained movement, I don't think, for a lot of these stocks until we get the next big move in gold pricing, which may be for a while. And that's too bad. Now, on a lot of these stocks, they're over their 200-day moving average, and some of them are even over their 200-week moving average, which probably might be a support level for them, which is good. However, we haven't seen the 200-month moving average come down yet to a point where I think these stocks, once that comes down, then I think you're going to have a real good chance of them making a significant move. And so technically, I think you're going to have to wait a while for a lot of these stocks again.
Well, Doc, if some of them are over their 200-week, and especially if they're over their 200-day, many would still say that's in the bullish side of the equation. Are there any, it sounds like it's not going to be a rising tide lifting all boats as people want the whole sector ripping higher. And it's more of a stock pickers market where there are stocks that are still outperforming because they have catalysts, because they're creating value. Are there any stocks on your radar that you really like where they're positioned because you like the setup of both their fundamental catalyst and where it looks on the charts?
I really like Kinross, and I think that's one of the stocks, and it's going to sell off here. We may get down to about $7.50 to $8 with Kinross, which, I would probably purchase some more. And I think we're going to see $8 at least in that. And then once again, it's going to be very important that at that point that Kinross doesn't break down further, because then we know we're going to be in a long-term sideways market in gold and silver. But if it can hold 8 and start trading sideways, I think that then we could see another move in gold and silver high sometime next year. And so that'll be what you have to watch. You're going to have to watch the weekly charts on some of these good stocks like Kinross to see if they'll hold, at the lower Bollinger Band and at their exponential moving averages of their 50s and so forth. If they can hold that area, we're going to be okay. There's not going to be a dramatic sell-off in gold then, and we're just going to see a sideways movement. So that's what you want to watch.
Man, Kinross even down to $8. That's still a 15% plus move, let alone if it goes down to $7. But you are right. Look, some of these stocks have gotten so far away from some of their moving averages that you could argue that could just be a natural correction. What about some of the smaller stocks, though, Doc? You know how much our audience likes to look at some of the juniors or mid-tiers to provide that extra torque. You need to be even more selective with those. Is now the time to be looking at some of those, or should we continue to wait?
I'd be very careful with the juniors right now. And we talked off mic about, for instance, a company like I-80 Gold. It has just gotten crushed. And that can happen to any of these companies, it seems, that they disappoint you and you're going to see a hit to your portfolio. So you're going to have to be very careful with the juniors, I think, in this environment, and look more to the mid-tiers where you have some chance of some production. And if there's others that, have good management and they're very careful with their expenditures, I think you're going to have to be so careful right now because of what just happened, as an example with I-80 Gold.
Well, Doc, it's not a really bullish picture you're painting here for the precious metals equities, especially the juniors. Let me ask you, are there any other commodities and resource stocks within that sector that have your attention as maybe better options than the precious metals at this point?
Not a lot right now. They're all struggling. You look at nuclear, you look at copper, you look at all of them, and I think we're entering into, and I think we're already into it, a recession. And I think, that's going to be with us a little while, and it's going to be a tough environment. And the problem with that whole thing is, even though growing your economy is going to be difficult, and that's true for the United States and for other economies, especially in Europe. Europe's a mess, and China has their own problem. The irony of it is we've seen a 75 basis point drop in Fed fund rate. But when you look at the long-term charts on the Treasury bonds, like the 10-year and 20, they're sending out a warning that you're not going to see those rates come down significantly, even if they keep lowering the Fed fund rate. In fact, it almost right now is, and I've said this before, is they're painting a picture of maybe in 2025, another leg down in the bond market. And that would be just tremendously difficult for the commodity sector. And someone would say, well, how could that happen in a recessionary environment? Well, inflation has not gotten down to where they want, although there are people saying that it's now going to move down to 2%. But right now, the longer-term bond markets are sending out a warning, and this could change. I'll put that caveat. But right now, those charts are telling you that the long-term bond markets aren't showing a bullish move up yet. They're in a trading range with the 50-month moving average coming down, and it's going to bisect that trading range sometime in 2025, and then we'll have to see what's going to happen at that point in time.
Well, Doc, in all fairness, the sell-off in the bond market, higher rates, especially on the long-term end, it has just shown this move back to kind of pro-America, pro-stocks, pro-risk on, because that's the move we've seen post-election. But in all fairness, that's the trend that the broad averages were on for a few years now after that 2022 correction. Look, I think we're kind of in this Goldilocks phase right here where we have a new administration coming in. They say they're going to be very pro-America, pro-business. Investors are clearly celebrating that. But we're not going to get anything happening until Trump actually takes office, and that's when he could potentially start to disappoint some of these market speculators. What's your outlook for the broad averages, though? Because, look, they have done so well, and it is a, I think, pro-U.S. and risk-on move.
Yes, and it defies levity. I mean,
but how long have we said that about these markets?
We've said it since 2008, actually. We haven't been in a secular bear market. We've been in a cyclical bear market. And in fact, you can say 14 years if you look at the charts. And it's got to come to an end sometime. And it's defying all logic. It's defying all long-term charts. And Trump, for all that he wants to do, and for all that he wants to do that is good from a domestic standpoint, he may be the fall guy for years of mismanagement in our economy and in these markets. I think this is just a Trump move. We'll come back, but then it remains to be seen whether he can accomplish what needs to be accomplished, or whether no longer are the markets in the hands of the government, and maybe they're going to be in the hands of the bond vigilantes finally. But we'll find out in 2025. 2025 is going to be a very important year.
Yes, it will be. Boy, oh boy, there's a lot of hope around a Trump presidency, at least what we're seeing in the financial world. We'll see what comes through with that. But Doc, overall, you're not painting a very rosy picture for us. However, look, there are clearly opportunities still in these markets with the uptrends that we are seeing. So as negative as some people might be in these markets, we're also hearing from a lot of technical traders more on the short end of things to take advantage of these uptrends and don't get too stuck in any individual sectors. That being said, hey, there are, again, continued opportunities in a pretty solid market still. Again, Richard Postma, thank you very much for taking time with us on this weekend show, Doc. We'll chat again with you next week. I hope you have a great rest of your weekend.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Second half of the weekend edition of the KE Report. And as promised, we are now chatting with Mike Larson, editor-in-chief at MoneyShow. I'll post a link in the show notes on our website and in your podcast player to the MoneyShow website, where you can check out all their upcoming conferences. Now, Mike, we're going to take a more broad look at these markets, dealing first and foremost with, I guess we can call it, optimism around the Trump presidency. This whole Trump trade, we're seeing a lot of sectors benefit. Bitcoin screaming higher, closing in on $100,000 as we are recording this. Small caps have benefited. Broad averages broadly are much higher. Financial sector is also benefited. What's your takeaway from, at least right now, the early on winners of that election result there, Mike?
Yeah, it's funny. The last two chart of the week columns I do every Monday on MoneyShow.com, and the last two chart of the week columns I did were basically about the Trump trade. How even before the election, the market was kind of leaning into Trump trades, and then essentially after the election, how every single one of those got turbocharged. And if you look across the board via asset class, it's okay. Trump is sort of the crypto candidate. That's the way he's perceived by the market. So you've seen Bitcoin and other cryptocurrencies explode. He's seen as, taking a lighter approach to banking regulation in addition to cryptocurrency regulation. So you've seen things like the regional banks, KRE took off, 10, 15% in just a few days. Obviously, Trump and Elon Musk have quite the bromance going. So you've seen, Tesla shares rocket higher on the assumption that, Elon Musk is going to get some payola or some benefit from, helping put his money into getting Trump elected. You've seen the dollar take off. You've seen oil fall on sort of the, drill baby drill is the slogan that Trump's used for a long time. And, that's great for energy companies that want to have access to new properties and things like that. But in terms of supply demand imbalance, more supply, especially U.S. supply, ultimately could, push, the price of oil down. So that's kind of been the Trump trade encapsulated in a nutshell. And, you've seen gold and silver on the flip side of that fall because some money that was in precious metals is going into crypto instead. And you're also seeing interest rates. I mean, the bond market's gotten like annihilated since Trump got in office, or looked like he was going to get in office. You already had bonds selling off kind of on the expectation that's the way things were headed in October, and that's gained a little more steam in November with the actual election results. So you've seen all of those asset classes move in that direction. I think ultimately, I think that some of his policies are going to get enacted, especially because it looks like there may be a red sweep with the Republicans not just taking the Senate, but also retaining the House. We haven't gotten 100% confirmation on that, but it looks like that's the direction that may be headed. And one of the problems is I think that, big picture, I think a lot of that is probably healthy. It's good, for the market. If you forget the politics of it, you just put your investor or trader hat on. What does the market want? It wants less regulation. It wants lower taxes. It wants, greater profits, all of that stuff, which is kind of what, the markets are expecting Trump and the Republicans to push through versus what you might have seen had Harris won. The one issue that I think in the very recent, kind of last day or two as we're recording this, that I've started noticing and thinking about is whether the incoming administration is going to score an own goal. If you follow soccer, you know what an own goal is. It's when you screw up and kick the ball into your own net and you score a point for the other team versus the other team scoring one for you. And the problem is if you don't get Trump or one of his surrogates out there soon talking about, or at least throwing a bone to the bond market and saying, look, hey, we're going to have greater growth. We're going to have this. We're going to have that. But we're still going to keep an eye on deficits and debt. We're not going to go way overboard. If you don't sort of, if you keep trumpeting, sorry about the pun, you keep trumpeting all the things you're doing to promote growth and tariffs and, promote U.S. business and so on, but you don't talk about the potential inflationary impact. You don't say, but you know what, we're still going to show some fiscal discipline. They're going to kick the ball in their own net. They're going to basically push things too far. The bond market's going to fall too much in price. Rates are going to move too much higher in yield. And what is that going to mean? That's going to mean the stock market struggles from here. So I think that's the real thing you got to keep an eye on in the short term. And you saw a little bit of it earlier this week when interest rates shot up again, and that actually caused the stock market to roll over on an intraday basis. So you guys, we've talked for quarters on end about my be bold view, and I still think longer term, again, forgetting the politics of it, longer term, what the administration is talking about is good for markets. But, in the shorter term, maybe from now through year end, got to try and show a little bit of discipline, or I think that things are going to get a little squirrely in the stock market.
Well, Mike, I think a great summary there of the kind of the post-election Trump trade and even the pre-election Trump trade. And you raised an interesting point about, messaging to the market or accidentally scoring a goal themselves. I think that you've seen a lot of the fear trade come off also because of the election certainty instead of the uncertainty people were expecting, and also probably the downplaying of geopolitical tensions moving forward because Trump has been vocal about putting an end to the wars that are going on. So I think some of the wind came out of gold. You saw the VIX sell off by 20% the day after the election, so people were pulling off their hedges, and the bond market selling off is, again, usually a safe haven play that people are in. So the animal spirits are back and the speculation is on full tilt. But at this point, do you think that they do need to address things like tariffs? How will they use them? Because they could be quite inflationary, especially if some of those tariffs boomerang back on U.S. companies when other countries put tariffs on the U.S. So do you think we need more clarity around what the plan is for fiscal discipline that you just laid out, and what can they actually do to offset the tax cuts? Where can they make cuts in government spending?
Yeah, a couple thoughts on that. I mean, first of all, you're absolutely right. Volatility, I think, there was probably a little extra volatility being priced in, a little extra insurance being bought on the assumption that the polls were so tight. It's not just that Trump might have or people I think were leaning towards a Trump victory, but they were also thinking, this could take a week, 2 weeks, a month, who knows how long to get a final answer. So I think part of the reason we had such a violent move, not just in equities to the upside, but volatility to the downside, is that we knew the answer within 12 hours of the polls closing, give or take. In terms of Trump himself. And then, we saw what happened with the Senate pretty quickly. The House is still out there, but it looks like that's going to go the Republicans' way, most likely, but by a slim majority. So I think part of it was just getting an answer pretty quickly or very quickly relative to expectations was part of it. And then part of it, again, is obviously having that mandate, having, the bigger vote totals than we had previously, where there were, that kind of gives him a little more, authority to say, look, the country's behind what I want to do. So the market's pricing that in. The issue with tariffs, of course, is that, forget what people are going to say about it from a political standpoint. The reality is, the foreign countries don't pay for it. We do. If you slap a tariff on goods coming into the country, what happens to the companies that sell those goods? They're just going to raise prices to compensate. So, that is a potential inflationary thing on the goods side of things. You've seen you've seen the supply chain, a lot of the pressures from inflation that we had as a result of COVID, plus the kind of tail end of COVID massive stimulus we had. A lot of that has come out of the pipeline. You look at the latest CPI figures. Is 3.3% year over year in the core CPI good? No, the Fed would like to see it closer to 2, but it's essentially half what we had at the peak in 2022 on a headline basis, given some of the declines in energy prices. We're back to that sort of mid 2s range. So we're not where I think the Fed wants us to be. We've been headed in that direction. So the worst of the inflationary push is behind us. But again, that does not include the forward-looking impact of tariff policy and some of the other things that may happen. So I think ultimately that's part of what the bond market's pricing in. They're not just pricing in greater growth, they're pricing in the potential inflationary impact of tariff policy if it gets extreme. And they're just pricing in, the fact that there's more of a mandate versus gridlock, a gridlocked environment in Washington. So again, the stock market is enjoying the euphoria effect, but just in the last 48 hours or so, you're starting to see that concern seep in, and I think that's going to be the big story. We've priced a lot of positive momentum in. People are going to start to say, if we don't get some discipline, or at least a sop to discipline, then that's going to cause issues in the bond market that, instead of just being sort of acknowledged, are going to be kind of worried about. So we'll see what happens there. Ultimately, again, though, I don't see anything to kind of change my longer term be bold thesis. I think, going back 6-9 months, I was telling you guys, I think one of the biggest stories is going to be money rotating out of Mag 7 into everything else. And boy, I don't necessarily think it would, or I should say, to back up all the way to July, we started seeing that in July and August, with those initial sort of shock waves where money came way out of tech, moved into small caps. And then we gave some of that ground back, but then post-election, we've seen it again. It's financials, it's industrials, it's small caps, it's value, it's all these other parts of the market, kind of like I was joking with somebody today, I call it sort of the Warren Buffett part of the market that's doing very well, whereas the stuff that was hot before is, it's not doing terribly. Tech's not down, but it's not leading as much. And, I think that's going to probably be the story as we head into the new year. And I think probably for most of next year, too. I think the forgotten parts of the market are going to have their day in the sun. And I think if you've got to look for where you want to be overweight, you want to be buying, you want to be adding exposure, that's where it's got to be.
So, Mike, on the point of these tariffs, look, and to tying that into small caps, I was reading recently that argument that, yes, tariffs are bad, they can lead to inflation, but they really impact the multinational corporations. Small caps are more domestic based. So is there an argument that it does seem like tariffs are coming from simply an investment standpoint, trying to step away from prognosticating what's going to happen data-wise? Will tariffs continue to help small caps then?
Yeah, look, what's the goal of the policy? It's to force more onshoring or nearshoring of manufacturing. It's to encourage repatriation of money here. It's to encourage hiring here versus there, and I put here and there in quotes, and so on. So, that's what the market's pricing in. It's pricing in sort of the America First economic policy relative to what we've seen for many, many years. So I think that rotation from a logic standpoint probably does make sense. But again, I would also point out, what's more levered to U.S. growth versus foreign growth? What companies generate the larger share of revenue and earnings in the U.S. versus foreign economies? And that's, like you said, that's the smaller caps. It's the companies that don't have as many far-flung manufacturing plants and markets, and that don't get 40, 50, 60% or whatever the number may be company to company of their sales overseas. So yeah, I think it's logical to expect that if policy is going to be tilted towards favoring domestic companies, domestic profits, domestic growth, and what have you, that's where investment dollars are going to flow too. So I already liked that part. I already liked a lot of those forgotten parts of the market, and I sure as heck like them even more now.
Well, Mike, let's also bring taxes into the equation here. Under a Harris administration, the plan was to raise taxes, obviously to bring in more receipts to the government, but it was going to affect investors in a negative sense because they were going to raise capital gains tax, especially on high net worth investors, with the likelihood that Trump is going to extend the tax cuts that he put in 2017. Do you think that kept some money from maybe panic selling the end of this year and keep the money in the market because now they don't have that overhang of the higher tax bracket starting next year and they can feel confident to leave their money in the markets? Is that a factor kind of, I guess, juicing the markets a little bit as well?
Yeah, man, you did all the work for me. I could just say yes, and that'd be the end of my answer. But no, in all seriousness, you're absolutely right. I think some of the tax implications and tax ramifications of the election play a part into what's happening here in this kind of condensed. I mean, when you think about it, from the election to the end of the year, it's really only about 7, 8 weeks. So in the short term, given the results, given sort of what it means for tax policy along with everything else, you're seeing a magnified impact on various things, including, as you said, people's desire to maintain exposure to the market versus take some chips off the table. I think ultimately, though, again, when you look at the longer term, when you look at what's going to happen over the next few quarters and next 12 months, if the Trump administration and Congress try to keep too many of these tax cuts, try to do more, and so on, you're going to be talking about deficit numbers and debt numbers that are just going to be astronomical. I mean, and the growth is not going to be enough to compensate. So I think, again, ultimately, longer term, the more the bond market, the sort of tremors or whispers in the bond market are ignored, the louder they're going to get, the more violent they're going to get, and the more the stock market's going to have to pay attention, and Washington's going to have to pay attention. So again, I think that we're kind of in the euphoria phase now and the ignorance is bliss phase now. But next year, I think part of this story is going to be what happens with rates. Is the bond market going to throw a little bit more of a tantrum? How much Fed cutting is now taken off the table? And is there enough growth boost from policy to offset that, the impact that you get to markets from cheaper money? And a lot of that's going to get sorted out as we head into the start of next year. So again, I think that we're probably going to start seeing some chop. We're probably going to start seeing a little bit of pausing, give back as people, the euphoria phase fades and some of the reality starts seeping in.
Yeah, that's the thing, though, Mike. We still have just under 2 months of people to guess what's going to happen before Trump actually has to do something concrete, which is, I think, just almost a sweet spot for markets. But then next year, boy, oh boy, that's when the big question mark is. Let's also talk about the energy markets and that whole drill, baby, drill policy. Now, a couple sides to this story. One being if U.S. increases production, which is pretty close still to all-time high U.S. production, you would think prices would come down. Maybe investors, maybe general US citizens would like that as gas prices could come down. Maybe that impacts inflation. But the flip side of that, maybe Trump gets really tough with OPEC countries and they shut off some of their supply to the US, which would increase prices. How do you balance out what's going to happen in the energy sector, especially around oil?
Yeah, sure. I think what I see for energy, kind of for crude, and I'll just say crude oil prices, WTI, Brent, whatever you want to call it. What I see happening with energy prices is kind of like what happened to gold back in 2022 when there were some bullish factors there, but the rising dollar, the surging dollar really was a governor on the gold market. And that's why, you had treasuries and stocks tank, but gold, I mean, relatively speaking, outperformed, but basically didn't go anywhere in US dollar terms. I would say you kind of have a similar thing here where policy, drill baby drill, will act sort of a governor on the oil market, but it's not like you're going to see a deep recession. It's not like you're going to see growth fall apart. It's not like you're going to see China continue to suffer. I mean, we were talking before we got on air about China stimulus and what impact that might have on commodities, and we've clearly seen China start throwing some money and not a small amount at their economy. So I think it's more of a governor type effect, where you don't see crude oil surge, but I don't think it's going to be saying we're back to $40, $30 oil or anything crazy like that. I think we're going to kind of be in that flop and chop range, and just that kind of environment like we had with gold versus just some collapse because we're going to have more supply out there.
Well, Mike, you brought up the surging dollar in that, and it has surged post-election along with rates. Typically, in the last administration for Trump, he wanted to have a weaker dollar, so this is kind of counter to what he actually wants. Could that be a real hitch in the get-along as far as the commodity sector moving forward? And what kind of monetary tools does the Fed have? And do you think Trump will kind of batter them again to try to get rates lower so that the dollar comes down. What do you think that dynamic between a Trump administration and the Federal Reserve will be in this administration?
Yeah, I mean, I think that's why you talk about gold. I mean, we've pulled back to sort of those high 2,500 range. We're pushing 27, 28, getting up to that level. And I'm not surprised we've seen gold pull back, especially because, again, I think some money, look, especially newer money that younger investors, some of them are just saying, I'm going to chase Bitcoin. And the part of my portfolio that I put in alternative assets, I'm going to take some money out of gold and put into Bitcoin because it's going up, or putting it into crypto because Trump's going to be more favorable to that. So I think that dynamic's clearly in play. The longer term, there's going to be this tension between the Fed and the administration. We already had Powell's press conference where he basically came out and said no when reporters started asking if he would step down. So it'll be interesting to see how that sorts out. But I think ultimately gold, and maybe especially some of the, silver, some of that's got a little more of the industrial component, probably does okay and probably, finds buying support because, again, you're going to have questions about Fed policy. You're going to have questions about the Trump, as you mentioned, not wanting the dollar to rise so much. Once we get out of this sort of euphoria period, what's going to happen? It's going to be probably bullish for gold. So, I mean, as a precious metals investor, if I was seeing what you've got here at 2580 or so versus 2800 in gold, I'd be buying. I'd be buying a lot, I think, because this, I don't think the sell-off, I mean, this isn't going to send us back to $2,000 gold, in my opinion, whatsoever. It's not going to be that kind of move.
One more quick one on the energy policies here is everyone's thinking Trump is going to reinstate some of these pipelines, export terminals, really just allow natural gas companies to export their natural gas, something that Biden shut down a lot of, which I think you can make the argument it kept natural gas prices low in the US, which does help out the individual with lower energy prices to heat their homes. How do you see Trump's policies impacting this natural gas price, which has been quite restrained?
Yeah, I mean, I think, one of the experts I was talking to or was reading his work, Elliot Gu, who has an energy-focused publication, he speaks at some of our events. He was talking about LNG exporters and companies exposed to that as being, one of the potential big winners because some of what Trump can do there is unilateral, it doesn't require Congress and so on. So, yeah, I think ultimately, natural gas exports, getting some of this supply out of the U.S. and into the global markets is clearly going to be something that happens more of. And I mean, look at U.S. natural gas prices. What are we doing? We're poking around at $3 now. The lows back in February and March were down about half of that amount. If the U.S. is shipping more gas overseas, we can sort of get more onto the world market and less just sort of sitting or being flared off in the U.S., then I think ultimately that's probably positive for that market in terms of U.S. prices, and especially, again, companies that are logistically involved in getting that gas from U.S. producing areas to global markets.
Well, Mike, let's also bring in the Inflation Reduction Act that was passed in 2022. The Trump administration has been very critical of it and said they're going to roll back some of the policies in there. What kind of impacts does that have on things like renewable energy, clean tech, EVs? And he even had sections in there that you would think he would be constructive on, like hydrogen power and nuclear power. But if he goes in with the scalpel to the Inflation Reduction Act, what does that mean for critical minerals, clean energy, that whole side of the market?
My take is that there's a lot of constituencies and a lot of senators and representatives in Congress whose districts have benefited from some of the spending, the largesse coming out of Washington in those sectors, in those regions, in those states, in those counties. So while I think Trump kind of had to talk politically about doing that, you're going to have a lot of these representatives who all of a sudden, if less money is flowing from the federal government to their districts, they're going to have some angry voters and some angry representatives. So I think probably of all the things that he's talked about, probably the things are going to have you're going to have regulations and some things that are no longer going to push EVs. They're going to roll some of that back. Some of this money that's been sprinkled all over the U.S. of A. I don't think they're going to just all of a sudden say, you know what, give it to us back. You're not getting any more, because that's a surefire way to get a fight with Congress. And if you want to maintain, the one side on the House situation, if they do have the majority, it's going to be a very slim majority. So you can't claw back all this money and the jobs that come with it and the growth that comes with it and expect to maintain, strict discipline in terms of people voting for your stuff. So I would be less worried about that. And I think the impact is going to be a little more muted on some of those companies that are involved in those spaces.
So, Mike, one quick follow-up. You already shared with us kind of your outlook for precious metals, but I want to talk real quick about the stocks, something like GDX, it's been on a great uptrend ever since March. Higher highs, higher lows, but it's been the last about 3.5 weeks now that it's been on a downtrend. And really, in about 3 weeks, GDX went from overbought to oversold on a daily chart. We've seen some higher volumes come in. Where do you see a bottom for GDX? Do you see this now as a buying opportunity, or is this going to be a next year when people realize just what's happening with policy type of thing?
No, I'd be buying here, and as we roll towards the calendar of 20, the point where we roll into 25, I'd be buying even more. I think, in terms of tactical positioning. I mean, I don't think this is the quote unquote end of the bull market in mining. I don't think that this is, more than people just reacting to, oh, the dollar is flying, and oh, Trump's going to do this and Trump's going to do that. But I mean, ultimately, these companies and precious metals in general, in an environment where there's sort of Trump-driven volatility, there's still some, geopolitical questions. There's tension with the Federal Reserve. There's, as Shad pointed out, when it comes to Trump, ultimately, is he going to want to see the dollar just take off and zoom to the stars? No, he's not. All that stuff's going to get settled in, and I think that we'll work through this. So, I'd have no problem saying, look, I think this is the end of the bull market. If I thought it was the end of the bull market, I don't, so I won't.
Well, just broadening back to look at the economy, maybe a little different than the market. As you know, Mike, we've heard for years that we were going to have a recession that never came. It was the most advertised recession that never showed up. Now, the yield curve has steepened and uninverted. There are some people pointing to concern still that maybe things aren't as rosy as the markets are acting like they are. Is there any potential that we do finally see that economic contraction come in next year? Sometimes the first year of an administration is a rough year. How are you looking at the health of the economy?
Yeah, look, I mean, I think that this economy is still, it weathered the slowdown that we had. We had, I think, already a soft landing. We had a bear market in 2022 that was pricing in some of that risk. All the stuff that was worried about, we've kind of already had. So if you now look at fiscal policy, potentially being more stimulative and under Trump versus Harris, if you now look at regulatory policy being more market friendly, if you now look at the tilt of money and growth kind of being more domestic versus foreign and so on, I mean, you add it all up, and it's one of those things where it's all, in my opinion, pretty fundamentally supportive of U.S. stocks. So I'm not worried about a recession. I suppose if we do get a complete rate shock, absolute mayhem in the bond market and so on, then all bets are off. But I don't think it's going to be like that. I think that it's going to be more, you get the pressure of rising rates. It kind of forces some more discipline. Some of the people that have been around for longer and the Republicans in Congress and so on are going to be like, hey man, look, you want to do some of this stuff, but if you don't, back off a little bit, the bond market's not going to be happy, and that's going to cause problems. So I think ultimately those forces will be sort of, will offset some of what Trump wants to do, and ultimately that in turn will kind of be more market friendly too. So I've said it before. If I see things that I think are real worrisome, real troublesome, that the market may not be appreciating, I'm going to call it out. But if I think that people are probably over worried given what's going on, I'm going to say that too. And I kind of think that's where we're at. I don't see a lot of reasons to panic, worry, fill in the blank for what one verb you want to use.
Hey, fair enough, Mike. You really have been one of our commentators over the last few years that has switched your bullish, bearish outlooks depending on what the market is telling you. So I really do respect your outlooks and your take as you see it right now. I think beginning of next year and in through even the first half of next year is going to be so critical to see if we do see any significant changes in trends, in markets, in commodities, really in anything on the back of the start of Trump's second presidency. We'll see how it all plays out, though. But very interesting this weekend show a couple different opinions on metals and markets. Again, next year, 2025, that is going to be such an early on in the year too telling sign of what markets can celebrate and what they're going to be disappointed with. Mike, thank you very much for your time on this weekend show, everyone. Thanks for tuning in to the KE Report. Again, please visit our website, kereport.com, or listen on your podcast player. Just search the KE Report to listen to all our daily editorials. throughout the week and company updates. Mike, thank you for your time. I hope you have a great rest of your weekend, everyone. Thanks again for tuning in.
You got it. Take care.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.